As we head toward the end of the year, I wanted to take a few minutes to share some high level thoughts on the markets, the economy, and what we're focused on as we prepare for our annual goal setting, cash flow modeling, and investment strategy discussions in the first quarter. And for those that are not a client of Puzzle Wealth, if you find this video helpful and you'd like us to model your financial plan, review your investment portfolio, or simply want to better understand the client structure we use at Puzzle, you can click the link in the video description below to schedule a meeting with me or a member of our team. And for those of you who want to take a deeper dive after my talking points today into the data, the full 2026 LPL market outlook is also available in the video description below. Please note, this is not about short-term predictions. It's about the primary forces shaping portfolios and long-term planning decisions as we move into the new year. Before we get into the themes, I also want to be clear about one thing. Most of the market views I'm sharing come from LPL Research and their 2026 outlook. At Puzzle Wealth, we have our own investment committee that develops our perspectives and our portfolio decisions. But we do regularly incorporate LPL's work as part of our broader due diligence process. With that framework in mind, I'd like to walk you through 7 key market themes LPL Research is watching for 2026, and then I'll wrap it up with where you can find more of our online content and a brief year-end message. So let's get going. Theme number 1, the U.S. economy and U.S. growth. LPL's base case for 2026 is what they call a slow start and a stronger finish. They expect the U.S. economy to grow at under 1% in the first quarter, specifically 0.8%, and then gradually pick it up as Fed policy eases and fiscal support filters through. For the full year, they see real GDP growth around 2%. So not a boom, but not a recession either. They describe this as a K-shaped economy. You're going to hear that a lot on TV right now, but what does that actually mean? K-shaped economy. Think of the letter K. It means higher income households are the top with strong balance sheets, investment portfolios, and home equity are likely to keep spending and investing. Whereas lower income households, on the other hand, face more pressure from a softer job market, higher borrowing costs, and persistent inflation. A major structural driver here is artificial intelligence. LPL expects spending on software, data, AI infrastructure, and data centers to take a larger share of GDP. The AI boom supports jobs in construction, which most people don't think about, manufacturing, and then, of course, technology services. They also see a modest boost in the back half of 2026 from the World Cup and the 250th anniversary celebrations of the U.S. Didn't really think about that, right? So it will help travel, hospitality, and consumer spending. The bottom line from LPL is there is no recession in the base case. There is modest growth and an economy increasingly driven by AI investment and then fiscal policy. Theme number 2, labor, inflation, and housing. With that growth backdrop in mind, LPL expects the labor market to cool, but not crack. Job openings are coming down. Wage growth is moderating, and layoffs, they're higher than during the post-COVID surge. But employment levels remain relatively stable. So that will help pull some heat out of this economy, especially early in 2026. On inflation, LPL's view is sticky, but drifting lower. Headline inflation may run near 3% early and then ease as the year progresses. Core inflation is expected to settle closer to the mid 2% range. They also point out that a shift from wage pressure to non-wage labor costs like healthcare and benefits, along with immigration trends and sector-specific shortages, all come into play. All this makes the Fed's job more complicated. On housing, LPL emphasizes that mortgage rates are driven more by the 10-year Treasury than by what the Fed is doing with the funds rate. So even if the Fed cuts, large deficits and heavy Treasury issuance can keep longer-term yields higher than expected. LPL's base case is that mortgage rates move lower, but only gradually, ending 2026 still in the high 5% range. The third theme, interest rates. One of the most important drivers in 2026 is how far and how fast the Federal Reserve cuts rates. Markets are currently pricing the Fed's fund rate to move towards roughly 3% by the second half of 2026. If that happens, LPL expects the 10-year Treasury to trade roughly between 3.75% and 4.25%, staying range bound. They don't expect a dramatic collapse in long-term yields or anything rising out of control. Inflation may cool, but it remains above the Fed's long-term target. So rates are likely to stay in that range rather than racing lower. On the credit side, defaults in so-called zombie companies are increasing. 2025 saw a record number of large bankruptcies, well above long-term averages. Even so, LPL does not see systemic credit stress, just more localized pressure. Keep an eye on that. For fixed income, their takeaway is simple. Returns are likely driven more by income than price appreciation. That 0 to 5 year part of the curve looks attractive for income according to them and our team. And duration positioning should stay close to neutral. The fourth theme, equities, earnings, and AI. Turning to stocks, LPL views 2026 as year 4 of the current bull market, which began all the way back in October of 2022. Over the first 3 years, the S&P rose by more than 80%. So historically, in bull markets that reached a fourth year, that year ended up being positive most of the time. LPL also looks at periods where the Fed cuts rates without a recession and markets that are near highs. In those environments, stocks have typically been higher 12 months later. It's good news. They view these rate cuts as normalization, not emergency easing. The most important structural driver, though, is that AI investment cycle. Large technology companies are projected to increase AI-related spending significantly over the next 2 years. That level of capital investment is meaningful relative to the size of the U.S. economy. On earnings, LPL expects double-digit S&P 500 earnings growth in both 2026 and 2027, driven largely by that large-cap technology. LPL outlines a fair value range for the S&P 500 with upside if AI productivity accelerates and downside if growth disappoints or rates rise unexpectedly. Key risks include narrow market leadership, valuation sensitivity, and geopolitical shocks. The fifth theme, sector and style leadership. LPL enters 2026 with defined sector tilts. They favor communication services, given exposure to digital advertising, cloud computing, and AI platforms. Technology, industrials, healthcare, they keep it at neutral, but consider them as upgrade candidates. Industrials will benefit, according to them, from infrastructure and AI-related buildouts. Healthcare becomes more interesting if market leadership broadens. LPL's underweight real estate due to office vacancies, remote work trends that are still around apparently, and borrowing cost sensitivity. Internationally, developed markets trade at lower valuations. Overall, they do, but they lack the same AI-driven earnings momentum. So remaining neutral. Emerging markets offer opportunity, but remain vulnerable to policy and trade risks. Overall, LPL is comfortable with benchmarking your international exposure, but keeping with U.S. leadership. Theme 6, policy, midterms, and volatility. Unfortunately, politics, or maybe fortunately, is back. Policy and politics play a major role in the 26 outlook. All House seats and a third of the Senate will be contested in the midterm elections. Historically, midterm years have been the most volatile in the 4-year presidential cycle. Markets often struggle heading into elections, but historically then do well once the uncertainty clears. Fiscal policy, infrastructure spending, and trade debates remain key variables. The message here is simple. Expect those headlines from the political world and volatility, but stay focused on long-term fundamentals. And last but not least, theme number 7, fixed income and portfolio construction. We come back to the portfolio side here. With rates expected to ease gradually, LPL believes bond returns in 26 will be income driven, as we mentioned before. They favor high quality bonds, intermediate maturities, and keeping duration near your benchmarks. They see opportunity, though, in agency mortgage-backed securities and investment-grade corporates, while being selective with lower quality credit. Higher yields exist in high yield and in the loan worlds, but rising defaults and refinancing risk require you to take caution. The takeaway is clear. High quality fixed income positioned to outpace cash, especially as the Fed lowers rates. Let your equities and other alternatives be your true risk-taking parts of the portfolio. So after those 7 themes, you might wonder, how do we use all of this at Puzzle Wealth? We do not simply copy any outlook. We review research, we pressure test assumptions, and make decisions household by household, client by client. January and February are when we bring this all together, updating financial plans, reviewing portfolios, stress testing scenarios, aligning your investments and tax strategies with your goals. If you're a client, we are very much looking forward to these upcoming conversations. And for all of you, if you're trying to figure out where to find us online, first of all, you found us on YouTube already. That's where you're watching this. We appreciate you being here. So if you find this content helpful, please like this video and subscribe so you don't miss future updates. But we're also going to be expanding shorter form content across multiple platforms. You can find that on YouTube Shorts, Instagram and Reels, LinkedIn for deeper insights, and Facebook for broader education. Wherever you prefer to consume content, our goal is to get it there and keep it simple. Clear, practical education you can apply in your financial life. If you'd like to know where to find us on any of those, if you can't, please reach out to me and I'll direct you. Now, to bring this all together, if you aren't a puzzle client, we'd love to see if we're a good fit for you. We'd like to model your financial plan. We can review your investment portfolio or, again, walk you through how our client structure works. To do that, you can click the link in the description to schedule a meeting with me or a member of our team. Thank you for spending your time with us and with me. As we head into 2026, I hope we all move forward with optimism, realism, gratitude, and perspective. I'd like to wish you and your family a wonderful holiday season, a healthy start to the new year, and also a year ahead filled with meaningful progress. Thank you for watching. I look forward to connecting with many of you in the months ahead for the client reviews. And for prospective clients, please reach out. We'd love just to have a conversation with you.